Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll talk about two aspects of mutual funds. One is, of course, can't take your eyes away from all-time highs. And the second part of the show will be focused on what does a mutual fund investor do if she or he has missed out on the bus thus far. But the first segment is about a very interesting new fund offer that is on, that will be on or is on maybe. From the house of SBI Mutual Fund. And Tanmaya Desai, the fund manager at SBI Mutual Fund, joins in to speak about the Automotive Opportunities Fund that they have come out with. Tanmaya, great having you. Thanks for taking the time out. This is Neeraj here. Good afternoon. Interesting time to come out with a fund or a sectoral fund like this. What's prompted this thought?
Right. So when we think about autos, we truly believe that there is long-term growth potential within the sector, within the theme. And the argument is actually premised on three aspects. One, definitely when we look at the underpenetration as far as the automotive industry is concerned across vehicle categories, it is quite starking in India versus a lot of other economies. And we also truly believe that there is a scope of much higher growth across vehicle categories. That's point one. Second, when we also look at the factor of affordability, we believe that has been improving. And that study we tried to do when we looked at the average disposable income increase and trying to tie it up with the increase in the average selling price of a two-wheeler or for that matter, even a four-wheeler. Clearly, we are seeing affordability improving, resulting into premiumization being a very nice play within the automotive industry. And that's true across vehicle categories as well as amongst the component players or the feature-rich element that a car is providing to you and me. And the third factor is auto again forms an integral part of manufacturing and to kind of also be a proxy to the manufacturing theme within that auto being one of the fastest growing categories, we believe auto kind of fits in well from our side in terms of a thematic offering where we truly believe in the long-term potential within the space.
Okay. There is a couple of thought processes here, Tanmay. One about how the sector has truly had a good run since the COVID lows, if you will. At least the index seems to suggest that. And if the commodity cycle is to turn a little bit, because if China indeed reflates a little bit and spends on property and reforms, etc., then what has been a real feather in the cap for autos, which is lower commodity prices, might become the Achilles heel. Now, is that a concern for the near term, or how do you think about it?
No, rightly asked, and if one tries to draw the attention of also the viewers, in 2018 or post 2018, we have surely seen a phase of hyperinflation where there was increase in the insurance cost. There was an increase in cost on account of the change in the emission standards from BS4 to BS6. And subsequently in 2020, also the industry being hit by COVID did have a torrid period where auto as a sector did not do well. Last 2 years in that context, we would believe has been some kind of a catch-up. And to that extent, the sector or the theme has done pretty well over the course of the last 2 years. I would like to draw attention to 2 or 3 data points with regards to where we believe valuations are or why it seems still fine to look at the theme at this point in time. When we look at the representation of auto and the auto ancillary companies within the broader indices, they are still much lower than the previous peak that we saw in 2018. That's point number one. Second, when we do look at the valuations for the sector and compare it with historical averages, be it on an absolute basis or even the premium that the sector or the theme commands versus, say, Nifty, we believe or we find that the premium is almost at around average that we have seen historically over the last 10 to 12 years. The third point is while the theme has done very well over the course of the last 1 year, auto has been in some sense a wealth compounder, and during the listing history of Nifty Auto, which will comprise our benchmark, we have seen it deliver 18% CAGR returns over the course of the last 2 decades. You did have a question with regards to the commodity aspect of it. It has kind of been benefiting in some small manner over the course of the last year. Of course, it's very tough to kind of necessarily predict. In certain baskets, we have seen an increase in the cost of the commodity, but I believe there are so many different pockets, whether it is within OEMs or auto ancillaries or even exports, whereby we believe we want to capture the high growth opportunity that the sector is going to offer, not just for the near term, but more importantly for the long term.
Okay, and now, interesting leaflet, I must say, or interesting data. I mean, the tagline, when you drive, India goes far, Tanmay, very well thought of. Some very interesting data points about how wiring content in EVs is multiple times what happens in the current EVs, or average volume weighted transaction price in India versus what's there. Now, how do you use, so for somebody who's watching you right now and trying to understand how would the house use some of the lower penetrated auto opportunities into this fund, what should she or he expect?
So let me try and elaborate that with probably how we are looking at auto ancillaries as a space, because that's a segment which predominantly will comprise of the small cap or the mid cap opportunities, and hence the growth opportunity is much higher. An auto ancillary company in its own life cycle can be a supplier to a single OEM. They can be suppliers to multiple OEMs within the same vehicle category. They can be suppliers to multiple vehicle categories, for example, a four-wheeler or a two-wheeler. They can be supplier of multiple components to the same OEM or to multiple OEMs, which may have synergy or even outside of that. And finally, we can also look at companies which are investing in technology. Some of them are also technology leaders. And within the same component that they may be supplying, they may add a feature-rich element to it, thereby increasing the content for themselves and also satiating the desire or the pull factor which is coming through now from a lot of consumers like you and me. So in that context, an auto ancillary can have multiple growth avenues across vehicle categories, across OEMs, across components, as well as across technologies.
Okay, so Tanmay, how would you characterize this? Because again, just trying to understand, for the discerning mutual fund investor who's got investment in flexi cap funds, let's say for example, and knows what percentage of that fund might be in auto and auto related names, how would this fund be different in its, or I mean, percentage allocation to auto opportunities versus an average fund might be? I'm not saying you have to be, I'm just asking if you will be.
Right. So when you look at a flexi kind of a category, or in fact, for that matter, any diversified fund versus whatever might be the benchmark that we may have, where auto weight today is in high single digits, one may position themselves depending upon where within the auto cycle one is by a certain percentage points higher than the automotive weight within the broader index. Now, when we are actually coming with a thematic fund like auto, of course, 100% of the investment will go towards auto and auto ancillary related stocks. Of course, we can discuss within that what are the buckets that we are kind of looking at, but it essentially gives an investor to participate in the theme in a holistic manner, especially in a category like autos, where we do see a sizable opportunity for a longer period of time. For example, right, while whatever the universe one may want to pin with regards to, say, the mid cap category or the flexi cap category, even within autos, we have a universe of around 134 stocks, of which probably 20 of them are original equipment manufacturers. The remaining are auto ancillary companies, most of them predominantly being small and mid cap in nature, and also some dealer companies as well as trading companies. So we do have a wide universe to participate in the auto and the auto ancillary theme. A thematic fund essentially allows us to go down the market cap, thereby trying to capitalize on the possible high growth opportunity that a smaller company in size may possibly have. Also, keep one thing in mind is that this fund will also permit us to evaluate stocks from a global perspective, thereby investing outside India. And to that extent, up to 35% of the fund can be invested in international stocks. So I don't think there is a dearth with regards to opportunities, and it allows an investor to wholeheartedly participate in a single theme, especially one which we believe is truly structural in nature.
Are you going to be investing that required amount in international stocks, Tanmay?
Even at a fund house level, we don't have any example where we have gone to that level of 35%.
Got it.
It's just for the interest of our, viewers, that I mentioned that that's what the fund does permit us to go to. Auto actually is a very global theme, and hence there can be many interesting ideas even sitting out of the country for us to evaluate and invest.
No, and because that's a differentiating factor, right? We don't get to
Yeah.
participate in global chip making companies and global EV opportunities because India is still at a nascent stage. So in that sense, that's very interesting too. Tanmay, what's the kind of, I mean, nothing is fixed, of course, but what kind of return-seeking investor should invest in a thematic fund? Usually people say thematic funds are cyclical and riskier. Autos seems to be a lot more structural than what some of the other themes might be. So I'm just trying to understand, should an investor who's seeking an X percentage of return look at this fund or something different? Can you outline that for us?
Sure, sure. See, by definition, a thematic fund will entail definitely a higher risk capability. And to that extent, somebody who is seeking more risk and as a consequence of that, higher return expectations is an investor who should evaluate a thematic fund. At any given point in time, while we always would educate and advise that there are various categories of funds that should be part of an investor's portfolio, a thematic fund should form only a small percentage of the portfolio for most investors. Now, this truly being in some sense structural in nature, and if one has to truly capitalize on the various cycles within the automotive industry, because again, every vehicle category will have its own cycle to play, then I think the minimum investment horizon that an investor should consider when they evaluate a fund like SBI Automotive Opportunities Fund should be a minimum of 3 to 5 years.
Got it. Well, we wish you all the best for this, Tanmay. Thanks for taking the time out and being with us and giving us some thoughts around this interesting opportunity.
Thank you. My pleasure.
All right, that's the view from SBI Mutual Fund. If you wanted to know what the automotive NFO is all about, you got a sense. I would urge you, all viewers, to try and speak to your financial advisor for seeking or understanding the appropriateness of a thematic fund like this in your portfolios. For some, it may be a shoe-in. For some, it may be not. So please do consult your financial advisor before you try and take any decisions on investing into not just this, but any thematic funds. But on the other side of the break, we try and get in somebody who's a market veteran and ask him, because he heads a mutual fund now, about what should people who missed out on the rally thus far do with their investments into the mutual fund space with the markets at record highs. Rajesh Bhatia of ITI AMC joins us on the other side. Back with the mutual fund show, and like we said, it's great to get somebody who's a veteran of the markets and now heading an asset management company or a mutual fund company to ask what should an investor do if she or he has largely missed out on the rally thus far with the markets knocking new highs. Rajesh Bhatia of ITI Asset Management Johnson right now on the show. Rajesh, great having you. Thanks for taking the time out. I would love to understand from you, Rajesh, typically when markets hit new highs is when people get a FOMO. Oh, I've missed out on this rally. Should I participate now or no? I would love to understand from you, what's your thought around this?
First of all, thank you, Neeraj. So basically, that's always a cycle of fear and greed, right? And as you point out, at the top of the markets, a lot of people feel as if they're left out. But here's what I would tell you. India is in a bull market. Across the world, it's rare to find a country like India, which has a fantastic predictability and a multi-year opportunity to grow. And we have been a fantastic stock market for the last 40 plus years. And in fact, the times are looking even better as you move forward. Of course, our valuations are a little extended and valuations are no longer cheap. We've had a fantastic 12 to 14 months in the equity markets. Large caps have done extremely well. Mid caps and small caps have done even better. So how do you approach, if you're a new investor now, how do you approach the markets? My advice at this moment would be that you go through a systematic investment route, right? You gradually increase your allocation to equity in India if you have not already participated so far. So it'll account for your corrections, etc., in case they do happen, because like I pointed out, we are at an elevated valuation cycle. The good news is we are at a very early stage of an economic cycle. So the bull run that we are seeing hopefully has multi-year legs. There's all evidence to tell us that there's a multi-year cycle which has just started 2 years ago, and this can last for another 5 or 7 years. So my sense is don't miss out on the India growth opportunity. It's a fantastic equity market story. I know that the valuations are elevated, but if you want to enter the markets at this moment, do it through the SIP route.
Do it to the SIP route. The other aspect, Rajesh, that people are now saying that with this, with an assumption that there is political continuity, because there's just this very strong vote of confidence that the Prime Minister has given in his interactions about the policy continuity likely to stay beyond 4th. Then the RBI dividend that has come in, which gives the ammo, presumably as well, for both the glide path as well as capex. Is there a sense that maybe, just maybe, the markets could surprise on the upside as well?
Well, I would certainly say that the markets are a little extended and probably incorporating the view that of the continuation of the current government. Of course, the RBI strong dividend, large dividend is a very positive surprise. We'll see what the government does with it, whether it spends and accelerates growth even further, reduces taxes, etc. But it's certainly a good needed ammunition for the government as far as its balance sheet is concerned. Can the markets go up further? It's possible that for the shorter term, given the enthusiasm and the continuation of the policy framework of this government for the next 5 years, that confidence could mean that the markets go up even further from here, especially the larger caps, probably in the mid caps and small caps. But I would say that there is still some value in the larger caps to kind of push it a little higher. But note that the assumption that the market is making is that this government is coming in comfortable form, and that's what the probably the leaves are telling us when we read the price. Regardless, I would say that this is a bull market. It's not easy to dislodge a bull market. It's like a very heavy train that is moving. You require a risk which is equally strong for that heavy train to kind of derail. So my sense is there's a bull market. There will be corrections. There will be sector rotations, which is what we've been seeing all along. But the bigger story is, like I said, stay invested in India.
Got it. Rajesh, thank you. That's a great one. Now, I'd love to understand, you mentioned that coming through the SIP route, I reckon that you would say they're coming on an index fund or a flexi cap fund to take advantage of everything under the sun, maybe even a large cap fund, because large cap valuations are a lot more modest, as I heard you say. What about people who want to let's say, take a little bit of risk, expose themselves to maybe thematic funds as well? What should those investors do who want to take that slightly higher bit of risk to get that slightly higher return?
So there are two aspects to this. As we interacted the last time, I told you that the value is in the mega caps, but really the India growth story is happening in the mid caps and the small caps. So that's one aspect. And if you have a reasonably long horizon of investing, which is 3 or 5 years, then I would say that flexi cap category also makes a lot of sense, as you move forward, which captures the mid cap and small cap. Despite the elevated valuations there, my sense is if you have a reasonably long time horizon, it'll correct itself because the earnings growth of the mid cap and small cap is going to kind of counter the elevated valuations that we have at this moment. As far as sectoral themes are concerned, look, every bull market has a leadership. This bull market leadership is in the capital investment space. So if there are thematic funds which focus on infrastructure or capital goods space or the investment phase, really, that is a sector fund that I would choose for the next 3 or 5 years.
And Rajesh, suffice to say that, as you said, that safety may be in large caps, but that's not where the India growth story is happening. And therefore, for somebody who's got this long-term view, as you said, even an SIP into the small cap or the multi-cap funds might not be a bad idea. I mean, almost everybody's frowning over it. But if I have a 5-year view, then is that such a bad thing to do?
It's not, because I think the kind of visibility that we have in the growth story of India, I would say, and where the energy of the earnings is, the earnings energy and the India growth story, businesses which can compound for the long term, 3, 5, 10 years, we are seeing them all in the mid cap and small cap space. So it may not be a bad idea to be in a multi cap or even a small cap fund if you are that longer horizon. And the best way to approach this is through the SIP route. Please do not get me wrong. I'm not saying that the large caps will not do well. There are enough businesses even in the large caps which have a lot of energy, particularly in the capital expenditure space, telecom space. Even the banks are looking reasonably priced at this moment. Having said that, I would say that if you have a medium-term horizon, go for a flexi cap because it will capture not only the balance of the larger cap opportunity, but it will give you a nice mix of mid cap and small cap opportunities, which are faster growing as well.
My final question, Rajesh. I know I asked you about a thematic fund earlier as well, but just one question. This whole, whether the money that has come in from the Reserve Bank or comes in from the higher GST collections, etc., to the government, let's say part of it used for the fiscal consolidation, but capex and thereby credit growth likely to happen as well. Would some of the funds which have got a higher exposure to capex or the BFSI theme now, because it's largely underperformed for some time now, be also pockets that discerning investors should look at actively?
Oh, absolutely. I would say both the sectors that you mentioned, capital goods or banking, is looking attractive. Capital expenditure stocks are definitely slightly on the higher side of valuation relative to the banks. But my sense is that the two important variables for banking are whether their margins are contracting or whether their credit costs are going up. There is no indication that either of that is happening. The results actually, the earnings season that's right now right now is actually suggesting that banks have kind of done quite well in this period. So my sense is that if there is a growth opportunity, there's a loan growth that goes up, NIM margins do not surprise too much on the downside, and credit costs are not showing any levels of getting elevated. So that my sense is that the banking story will continue, and the valuations comfort is also there as far as banking is concerned.
Got it. Rajesh Bhatia, really appreciate you taking the time out and joining us on such a short notice. Thanks much for giving us your thoughts.
Thank you.
That's all the time that we have on this leg of the Mutual Fund Show. I hope this was helpful. I'm sure it was, rather. Thanks for tuning in. Stay tuned to NDTV Profit.